Here's a story breaking that sounds technical, boring even, until you realize what it actually means. Because buried inside the fine print of global markets is a moment where very powerful players got caught flat-footed. And when that happens, the consequences travel fast, and they travel fast. For years, the silver market carried a secret that almost no ordinary investor could see, a $6 billion short position quietly sitting in the background, shaping prices without ever announcing itself. Because this is how power prefers to operate in financial markets, silently, indirectly, and with the comforting assumption that nobody will challenge it. This short position was not a casual bet or a speculative trade placed by a reckless actor looking for a quick profit. It was systematic, calculated and sustained, spread across contracts, institutions and timelines in a way that made it appear normal, even inevitable, as if silver prices simply belonged where they were. The strategy depended on one critical belief: that silver demand could be managed, delayed or discouraged, and that price spikes could always be smoothed out before they became dangerous. As long as confidence held, the trade worked, because markets often move not on reality, but on expectations, and expectations were carefully guided. What made this position especially powerful was its invisibility, because when a short becomes large enough and persistent enough, it stops looking like a bet and starts functioning like a form of control, subtly pressuring prices downward and signaling to the market that resistance is pointless. Investors watching charts saw stability, analysts talked about fundamentals, and behind the scenes, the short grew larger, more confident, more exposed. This was not one player acting alone, but a pattern reinforced by institutions that believed the rules would never change, that liquidity would always be there, and that silver, unlike gold, would never attract sustained attention. But the danger of a hidden position is that it relies on silence, and silence is fragile. The moment enough buyers decide that the price no longer reflects reality, the illusion collapses. A short position of this size does not fail slowly, it fails all at once, because every dollar increase becomes a threat, every uptick a warning, every surge a countdown. What looked like market stability was actually tension, stretched tight over time, waiting for pressure. When that pressure arrived, it revealed how concentrated the risk really was and how dependent the system had become on the assumption that silver would remain ignored. The $6 billion were not just money at stake. They represented leverage, confidence, and a belief in permanent control. And once that belief cracked, the trade could no longer hide in plain sight. What changed everything was not an announcement or a headline, but a sudden and unmistakable surge in demand that arrived faster than the market's defenses could absorb. Because silver demand does not need permission to appear, and when it does, it moves through multiple channels at once. Industrial buyers stepping in to secure supply, investors seeking protection against currency risk, and retail participants sensing an opportunity where prices no longer made sense, all converging at the same moment. And this convergence is what transforms a controlled market into an uncontrollable one, because demand is not a single force but a cascade, and once it starts, it feeds on itself. Rising prices attract attention, attention brings more buyers, and more buyers accelerate the very movement that short sellers depend on, never happening, which is why this surge mattered so much. Because it did not come from one predictable source that could be neutralized, it came from everywhere at once, revealing that the assumption of manageable demand had quietly expired, and as buy orders stacked up, the price began to move in ways that exposed how thin the margin for error really was. Each incremental rise tightening the pressure on short positions that had been built under the belief that silver would remain passive, and that belief had shaped years of behavior, discouraging long positions, encouraging complacency, and reinforcing the idea that any spike would be temporary. But this time the spike held, and when a price holds, it changes psychology. It tells buyers they are not alone, and it tells sellers that control is slipping. And in leveraged markets, psychology matters as much as capital, because leverage turns hesitation into urgency, and urgency into panic, and the surge in demand did exactly that. It forced participants who had been comfortable for years to suddenly reassess their exposure in real time, watching screens where numbers moved not in their favor, but against them. And the problem with a large short position is not the initial loss, but the accelerating nature of risk, because losses grow faster than the price itself. And as silver pushed higher, margin requirements followed, forcing decisions that could no longer be delayed. And this is where demand becomes decisive, because every forced buy to cover a short adds to demand, creating a feedback loop that pushes prices even higher. And what began as organic interest turned into mechanical necessity, a market dynamic that feeds on imbalance, and the imbalance had been years in the making, hidden beneath stable charts and calm commentary. But demand has a way of exposing what patience hides, And once the surge crossed a critical threshold, it stopped being a question of fundamentals and became a question of survival for those on the wrong side of the trade. And survival trades are never graceful. They are fast, reactive, and expensive. And as silver continued to climb, the narrative shifted in real time from why is this happening to how far can this go, and that shift is deadly for short sellers because markets move hardest when uncertainty replaces confidence, and the surge in demand did more than raise prices. It broke the assumption that silver could be ignored, and in markets attention is oxygen, and once silver had it, the entire structure of suppression began to unravel, revealing that the price had not been low because demand was weak, but because demand had been discouraged, delayed, and underestimated. And when that dam broke, the water did not trickle, it rushed, carrying with it the realization that control in markets is always temporary, and that demand, once unleashed, does not negotiate, it overwhelms. The moment margin calls began to ripple through the system, the true scale of over-leveraged positions could no longer be concealed, because margin is where theory collides with reality. And leverage only feels invisible until the bill comes due, and in this case the bill arrived suddenly and without mercy, revealing that what appeared to be manageable exposure was in fact a fragile tower built on borrowed confidence. Margin calls are not opinions, they are mechanical demands issued by the market itself, triggered automatically when losses exceed agreed thresholds, and when silver prices move sharply upward, those thresholds were crossed faster than many participants had prepared for, exposing just how thin their buffers really were. For years, leverage had amplified profits while prices remained stable, creating a false sense of security that encouraged even larger positions, because when volatility is suppressed, risk appears smaller than it truly is, and that illusion invites excess. The over-leveraged players believe they had time, liquidity, and flexibility, but margin calls remove all three at once, because they demand immediate action, either inject more capital or reduce exposure, and when multiple institutions receive that same message simultaneously, the system tightens. What made this episode so revealing was the speed at which capital requirements escalated, because leverage magnifies not just gains but urgency, and as silver continued to rise, margin requirements recalculated in real time, turning paper losses into cash demands that could not be ignored. Positions that had been rolled over comfortably for years suddenly required fresh capital, and not in small amounts but in sums large enough to force difficult decisions, selling assets, closing trades, or liquidating positions that had been considered long-term strategies. This is where over-leveraging becomes visible, because truly balanced positions can absorb volatility, but overstretched ones cannot. And the scramble to meet margin calls exposed how many players had been relying on stability rather than resilience. As capital was pulled from elsewhere to plug these gaps, stress spread beyond the silver market, because leverage connects markets invisibly, and pressure in one corner forces movement in others. What had looked like isolated risk was revealed to be interconnected exposure, and margin calls acted like a spotlight, illuminating the hidden wiring of the financial system. The most dangerous aspect of over-leveraging is not the initial decision to borrow, but the assumption that conditions will remain favorable long enough to unwind gracefully, and margin calls shatter that assumption instantly because they do not negotiate with narratives or expectations, they enforce math. Each forced reduction in position added buying pressure to silver, which in turn raised prices further, triggering additional margin calls in a cascading effect that fed on itself, turning individual risk management problems into a collective crisis. Institutions that had prided themselves on sophisticated models found those models lagging behind reality, because models are built on historical behavior, and this moment broke historical patterns. Liquidity, which had always been assumed to be available, began to evaporate as too many participants tried to do the same thing at the same time. And this is where leverage shows its sharpest edge, because it depends on liquidity that disappears precisely when it is most needed. The exposure that margin calls revealed was not just financial, but philosophical, showing how deeply the market had come to rely on the idea that silver prices could be managed, capped, or corrected before reaching dangerous levels, and when that idea failed, the leverage built upon it collapsed. What had been framed as efficient capital use was revealed as concentrated risk, and the distinction matters because efficiency assumes control while risk assumes uncertainty, and the margin calls proved that uncertainty had been underestimated. As positions were unwound under pressure, the market began to see which players had prepared for volatility and which had simply assumed it would never arrive, and that distinction reshaped confidence. Margin calls stripped away the comfort of gradual adjustment and replaced it with immediate consequence, forcing transparency where opacity had thrived. Overleveraged positions, once hidden behind complex structures and rolling contracts, were suddenly visible through the actions taken to survive, and those actions told a story the numbers alone could not hide. Capital injections signaled distress, forced buying signaled vulnerability, and rapid deleveraging signaled that the market had reached a breaking point. In exposing these positions, margin calls did more than enforce rules. They changed behavior, because once leverage is punished rather than rewarded, caution replaces confidence, and markets reprice not just assets but assumptions. The collapse was not merely about losses incurred, but about credibility lost, as participants realized that the strategies they had trusted were far more dependent on calm conditions than they had admitted. In that sense, margin calls served as a reckoning, revealing that the stability of the silver market had been propped up by leverage rather than supported by balance. And when leverage was tested, it failed loudly, publicly, and all at once.